And we're live. Cool. Good to see y'all here. Today's panel here is Stablecoin Adoption in Emerging Markets. So we've got some amazing folks that have been at it both on the consumer side and the business side, building in stablecoin around the globe. So I think it's going to be a great conversation today. We'll do a quick round of intros and we'll jump right into the meat of it. So I'll be your moderator today. I'm Tanner at StableC. We are an enterprise treasury solution for stablecoins around the globe. So with that, I'll hand it to Chris.
Yes, I'm Chris Murray, CEO of Yellow Card. We are the largest licensed stablecoin payments infrastructure provider for Africa and the broader emerging world.
I'm Daniel Vogel. I'm the CEO and co-founder at Bitso. We do a lot of similar stuff to Yellow Card. We just do it in Latam.
Hell yeah.
Awesome. Hey folks, I'm Ezra, CEO and founder of Kaliza. We help businesses with stablecoin-enabled payments or fiat payouts into Asia, Latam, and US.
Hi, my name's Mike from Sling Money. We're building WhatsApp for Money, or a global Venmo, on top of stablecoins, available in 140 countries with fiat ramps in 75 of them.
Awesome. And so first question for the group here is we want to dig into use cases. So when we think about use cases in emerging economies, obviously you've got consumer use cases and you've got business use cases. So maybe first question, kick it off to you, Mike, and then to Daniel for LATAM. But what are some of the consumer use cases? And then we'll move into business use cases for Ezra and Chris.
Yeah, I mean, I think the most basic consumer use case is, people want to move money from one country to another, one currency to another, one person to another, and they want that to be quick, they want it to be cheap, and they want it to work every time. And I think that, stable coins offer a faster, less expensive way of moving money from, A to B, and promise to really do the same thing for moving money that like voice over IP or Skype did for phone calls, where you don't think about making an international phone call or a long distance phone call anymore. You just make a phone call, and that should be true for moving money too, which is fundamentally just information, in the same way that your voice is just information. And so I think this technology allows for, it's just a better mousetrap. It's a better way of solving a problem that people have had for a really long time, and that's a very basic consumer use case. Another consumer use case which is meaningful is getting access to more stable currencies. If you live in a place where your currency depreciates against G7 currencies at a high rate, I think a lot of people would prefer to hold dollars, or maybe in a couple countries euros, rather than holding the local currency. And in many cases I think that can be easier to do with stable coins than it is to do with like a fiat account. Whether or not that remains easier as regulators kind of catch up, I don't know yet, but my guess is that it does remain easier because the technology is just like harder to control. It's just like it's native internet money. And the example I always give is like the French don't enforce their content standards on Netflix in the same way that they do against, satellite television or cable television. So I think those are really critical things that a lot of people in the world want: faster, cheaper money movement, access to stable currencies. And if you can do that and you can provide that to people, I think you're providing a great service. And then the third thing is allowing people to get paid from other places. So if I live in a country that is not very well connected to the global economy, I do work online, and I get, for an American company or a European company, there are stablecoin use cases, stablecoin products that make it really easy for me to get paid in the US or Europe and then access local fiat currency easily. So those three things I think are each individually killer.
Yeah, so not a lot to add because I think you've covered kind of like the three things that we see the most. I'll just tie two little stories on this front. So you were just telling me, we were just talking about like potentially a trip between London and Mongolia that I did 15 years ago and you're thinking about doing now. And one of the things that's like very few people in the world realize is just how like the branding that the US dollar has. It's really remarkable. I mean, you can be in two neighboring countries right next to each other, and you cross the border and you stop having the currency of the country that you just left being accepted. But you can use dollars everywhere. You can be in the most remote region of Central Asia and someone will take an American greenback. It's incredible. That doesn't happen with any other currency. And stablecoins have now basically tokenized that and are leveraging that branding power that the dollar has, and basically an incredibly powerful mechanism to export the dollar to the world. We operate in countries like Argentina that people literally have been keeping physical dollars in their houses under their mattresses. It sounds kind of crazy, but inflation and devaluation were such a big issue that people prefer to basically figure out a way to take dollars, and there's all these amazing stories of people who've traveled with briefcases full of dollars to sell, et cetera, et cetera. And now you've basically, in the same way that the internet allowed people to basically get access to information, and this is just information, now you can basically just get this information tokenized and have it in your wallet and keep it safely. And so I think the combination of sort of that branding with the easy digital access is becoming very, very powerful. And then just the other thing that I would add here is, because some of these economies in some of them you have very good talent, really interesting people, etc. Like a lot of people are starting to now look for opportunities to work just not in their countries. And stablecoins have become one of the mechanisms in which people are getting paid and able to store that. And so we're definitely seeing a really interesting uptake on the consumer side there.
There are only two universally recognizable means of transferring value. That's a $100 US bill and a bottle of Johnny Walker Black Label. That's it. Only two things recognized everywhere in the world.
There it is. Super interesting on the consumer side. So, Chris and Ezra, talk to us a little bit about business use cases. Like, where are you seeing the adoption? Is it import exporters? How are these folks figuring out why they want to use stablecoin? Where is it? Like, talk to us a little bit about the B2B use case in emerging markets.
Yeah, I mean, I think at the end of the day, the business use case is quite similar to the consumer use case, right? It's just a lot larger scale, right? Whereas, a consumer in any of these countries that we're talking about might need to, make a couple $100 payment, right? The business needs to make a couple $100,000 payment, and they need to do it daily. They need to do it on a far more frequent basis than most consumers are. And it's really a lot of the same use case though. It's treasury management, it's international payments, and it's access to the dollar, right? All of these businesses across emerging markets are dependent on the dollar. And when you talk about the dollar's branding and the dollar's staying power, right? Most invoices around the world are still settled in dollars for international transactions. Most international payments are still flowing through New York when they're before they're settled in the disbursement country. And so the access to the dollar and the ability to move the dollar more easily is extremely important to these businesses. And it's quite an easy decision for them to start using stablecoins. And I think the reason that you've seen so much adoption from these companies, especially from companies in remittance and payments and other forms of financial services over the last 6 months or so, is now you have regulation that supports it, right? You have an administration in the US that supports the use of this technology, which obviously helps a lot with businesses. And it solves the problem in a very unique way. It solves their problem in a way that they otherwise didn't have, where even though I can't access dollars through the banking system, even though there's not enough dollar liquidity in the country for me to be able to make these payments frequently, I'm still able to facilitate these payments. I'm able to continue to keep my business going. I'm able to facilitate imports in a lot of cases for critical goods, right? For food, for medicine, for things like that. One statistic that I like to tell people is when you look at the African continent, only 2 countries are able to feed themselves, right? There are 52 countries on the African continent that have to import food to feed the population, either from neighbors or from Europe and India. And so, again, this technology is facilitating imports not just for consumer goods, right? Not just for consumer electronics or other sort of nice to haves. Although I would argue my cell phone is not a nice to have, but I think it's also facilitating it for food, for medicine, for critical industries. And so, it's a technology that is becoming more and more important in emerging economies, especially in some of the ones where, dollar liquidity is extremely scarce right now.
Interesting. Ezra, what are your thoughts?
Yeah, I'll maybe give like two stories. One kind of a more direct B2B narrative, similar to what Chris was sharing. One is sharing my own consumer lens, which is one I think you guys have spoke to quite well. I've had a few experiences in my life where I feel that I didn't really realize how important the dollar was as an intermediate currency until these points. One was I embarked on what I call my millennial quest many years ago before I took a break and before starting working at Visa, and traveled for a bit. And I remember traveling between Egypt and my parents hail from Ethiopia and Eritrea, and so I flew directly to Ethiopia. I had no dollars whatsoever with me. I had Egyptian pounds, and I, funny enough, thought, I was like, I can just change these easily. These are two countries that are connected by the Nile. They'll have a easily swappable currency from Egyptian pound to Ethiopian birr. And to my surprise, that was not the case. They're like, we'll only take dollars. That'll be the only form of taking it. And I learned from a previous experience in Guatemala as well that the dollars cannot be tainted, they can have tears in them. There's like all these like points of concern around like physical hard cash. And so I remember I was like, thank God, all these all the legal tender I had with me was not torn, but I did not bear in mind that you had to have US dollar in exchange for local currency. So I went through this harrowing experience where I Venmo'd my mom, who then paid my grandma, who my mom then had my uncle, or my mom's uncle, then go to the bank, give me cash in Ethiopia. It would involve like 4 different parties to make that happen. So you can only imagine like how that scales for a business use case. And I'll give you an example. I'll give you an example of Kaliza and one that just came to mind right now. One is today we'll work with importers that want to say bring in products from Tramontina, being one of the largest stainless steel exporter of products, and share this example with a few folks here. Their hub being in Brazil, they furnish and supply a lot of the silverware in the cafes in Europe. They provide my trash can, pots and pans in many homes across the Americas. In many cases, for importers that are working with such a large supplier, there's difficulty in even getting them money in the first place because they cannot get access to banking. And that's because there's a long tail of regional banks in the world that have to find access to a US correspondent bank. And typically it's not just to park dollars, it's not just for the sake of saving in dollars in the US, which is what I think a lot of people thought was the only need or use for stablecoins. It's really as a conduit to access the rest of the world. How do I actually pay out to Asia? How do I pay to my suppliers in Hong Kong or mainland China? How am I sourcing commodities across Africa, among others? And the one that came to mind was I was just looking at your socks, which are really dope socks. And I was like, to make those socks, we take it for granted today. But I was like, that probably was a result of cotton sourced from the US and India that made its way to then being processed in Central America, that then made its way to being sold by an online merchant here in the US. And in that supply chain, each of those players had to get into dollars before they were then able to pay the next member of the value chain to make that happen. And that's 4 hop skips that occur, assuming there's only one intermediary bank. So this is all a long way of saying that I think there's an exciting opportunity within B2B that we're just starting to see, and we're just barely touching the surface on, of how do you remove intermediaries and make it as frictionless as possible to send payments cross-border using stablecoins pegged to the dollar as an intermediary value. Exchange of value.
Super interesting, and I think open question for the group. So anyone that wants to take this question, feel free and jump on it. But I think for the audience here too, why is it the case that the correspondent banking system doesn't work as well as it does, and why is it the case that stablecoins are getting this adoption? And I guess really what I'm trying to scratch at there is, I think for folks in the audience, you take US dollar from a bank account, you'll convert it into a stablecoin, you'll send that stablecoin on chain, it'll be unwound into local fiat and then paid out in the economy of choice. And so what are some of the constraints with that? But also is it cost, is it liquidity, is it regulation, is it compliance? But then also why is that simple flow of taking US dollar or the reverse, why is that so innovative as it relates to the current model with the correspondent banking system?
I used to work at a bank, and one of the things that you realize when you do that is that Swift is just, it's a messaging system, it's an email, that goes out, and then a bunch of work needs to be done on the back of that email, and often there are people sitting there like doing that work. And it's a very old technology, and really what it does is it bridges these incompatible databases. So, Bank A has a database that they built on top of like a, AS400 and all this shit, and then Bank B, I don't know, they use Solaris or whatever, and they both have their thing. And then there's an email that goes between those two systems, which is literally an email, to bridge these two incompatible databases. And like, there's all sorts of settlement, all sorts of things that need to happen on the back of that, a lot of which is just done with like, spreadsheets, right, that are passed back and forth. And this was state of the art, at some point in the past. It, clearly is no longer. Now, what is a blockchain? A blockchain is actually a database. That's all it is. But it's a database that everybody has equal access to. And so the real innovation here is that, like, with stablecoins and fast blockchains, everybody shares the same database. And the movement of money is actually just, it's just an API call that moves money from this token account to that token account, from this ledger address to that ledger address, and Bank A, Bank B, and user 1 billion are all on the same database. And so, naturally that is like faster, more efficient, cheaper. You don't get rid of, there are still all sorts of compliance costs, there's still all sorts of other costs that are attendant with like moving money and so on and so forth, and there are regulatory obligations. Those get more efficient as well, for other reasons. Actually, transaction monitoring and law enforcement is easier if everybody's on the same database too, because you could see everything, which I think people don't really totally grok yet, which is like everything in a blockchain is more visible, in fact. But yeah, just like that basic technological fact, it's like when HTTP was introduced, and the hypertext transfer protocol made it really easy to move images and text around, and this is why we don't read the New York Times on paper anymore. It's exactly the same thing.
But I do feel like there's, so I fully agree, like the vision is super powerful. You have distinct systems, they've been built throughout history with different technology stacks, and now you finally have some commonality that can bring them all together and allows them to communicate, just like you can have a different email system than I do, but we speak the same protocol and we can exchange messages. Stablecoins are kind of the same. But I do feel like there's still some important roadblocks to really unlocking this future of like money that just moves on chain and where everyone's fully on board and using that. So for example, I'll give you a few things that I feel like are roadblocks. So liquidity is important. And so some places have figured out fantastic ways to bridge liquidity between USD stablecoins and local currencies. But in other places in the world, it's still hard, right? And so there's a bunch of businesses that are trying really hard to solve that, the liquidity question. I think, in some jurisdictions, compliance continues to be very difficult, because you may have the consumers who are like kind of interested and they don't really care much. They want the faster, easier, whatever access. But like, companies need to comply with a bunch of rules and regulations. I mean, customers as well, but it's kind of like harder. And so, we definitely see cases of big corporates in Mexico who someone inside the corporate has fully bought into the vision, Mike just laid out, but then they go into the accounting department, and the accounting department is like, well, we don't actually really know what is the legal treatment of this thing. And so there's still like, that's why things like the Genius Act in the US is going to be so important, because it's going to just like trickle. Like the other thing that's, apart from having a currency that everyone in the world accepts, as well as a Johnny Walker bottle, though if you go through Iran, don't do that in Iran. But the other thing is like the US continues to be a really important thought leader in the world. And we at least have seen that, the jurisdictions where we operate, everyone has their own flavor of things, but everyone pays a lot of attention as to what's happening in the US. And so rule clarity that'll bring compliance, it'll help with liquidity, it'll help with the use cases, and also just like the branding of stablecoins is important, right? Like these stablecoins are a child of the crypto industry. And the crypto industry for a really long time has had a fairly difficult to understand narrative. Right? Like, what is decentralization? What is sovereign tokens? Like it has like all these layers that, like, even mining, like I still get asked about mining these days. And I think we still have a lot of work to do in basically demystifying and bringing the value proposition front and center, solving problems for customers, making sure that you get the fast, you get the good pricing, you get the good access, you get the network effects, et cetera, but there's still a lot to build.
Yeah, I mean, when you talk about like the correspondent banking system, right? I'll say something to really fire up the patriots in the audience. I've sent money from the U.S. to Europe before. It's not actually that bad. Like, it works kind of fine. Tony's in the front row. He's steaming right now. He's angry at that. So I know all my stablecoin guys, me too, in the audience. Everybody wants stablecoins replacing the correspondent banking system tomorrow. The reality is that when you look around the world, in developed markets, you have essentially these super highways, right? These interstates of money movement, which is the correspondent banking system and the SWIFT system, and that connects the U.S. and Europe and the UK and Hong Kong and these parts of the world, and it actually works generally well, right? This is how the entire world economy functions. That's not necessarily the biggest, most pressing issue, at least in my opinion, right? The issue is that off of that interstate, you have these winding dirt roads through the Grand Canyon littered with potholes, and your car only gets 3 tires when you need to go to any emerging market. When you need to go to most parts of the African continent or a lot of South America or Southeast Asia. And that's where the system completely breaks down, right? There's toll booths the whole way through, right? You have to be able to make it through in the first place. You have to, find gas, and there's no gas stations for 600 miles, right? So there's just a number of issues when you start getting off of that super highway between, the US and other developed markets. And that's where stablecoins, in my opinion, really come in, right? At some point, look, eventually we will have flying cars, right? And none of this will matter, and you won't need the interstate, you won't need the roads, and everybody will just fly around on stablecoins, right? But, for now, stablecoins are the first technology that come in and actually pave those on and off ramps to this interstate, and make it possible for, to Daniel's point, right, these on and off ramps and these bridges between local currencies and stablecoins develop, actually make it possible for these companies in these markets to be able to interact with this global highway of money movement and this global system of money movement. And, that's the biggest thing that it's solving today. Right? I think, again, if you look out, 10 plus years, I think that, it replaces, a lot more of this infrastructure, and you end up in a world where all of this stuff is just running on stable coins, because eventually the best technology is going to win. But for now, it's what it's really doing is helping these emerging markets that just previously did not have sufficient ways of being able to interact either with each other or, with this global system, of actually being able to get into the correspondent system in the first place, right? And then we can talk about fixing the correspondent system.
Super interesting, Ezra. Any closing thoughts there before we go into the next question?
Yeah, I'm preaching to the choir here. I think if you're sitting here and you spent $2,000 to, listen to us speak, you probably believe in stable coins. But I think, speaking to the audience outside of here, the first step was getting trust and I'd say general, obviously excitement around crypto, around stablecoins. Then it was really seeing regulators come around to it as well. And the last mile was really, going back to the point of the end user. How do you get them to understand that there are no repercussions to them? And if you look at it from a business standpoint, it's how do I know that I'm not going to get in trouble from a tax or regulatory standpoint, that using crypto is not perceived as evasion, and it's actually just another form of money remission, and that I am then capable of sending funds from my holding company in the US to this entity in Brazil or this entity in Japan to facilitate local operational expenses, to manage payroll, to pay my supplier for XYZ parts, right? And I think that's the last hurdle on the business side. On the consumer side, a thought that I've had for some time, even before crypto, you know, the word checking account is highly regulated all over the world, right? And I'm sure many people in this room have come across this problem. There was a quite renowned public company that I love and respect and hold dearly that launched a high yield checking account many years ago and learned this lesson for the whole ecosystem. And US regulators, specifically FDIC, stepped in and said, wait, that is not a checking account. It's a money market account. It's SBIC backed. And so everyone else in the ecosystem that launched similar products eventually launched what they call cash management accounts. And the reason I think this is an important lesson is that like terminology and wording is everything all over the world. I mean, it's the same case whether it's a conta corrente in Brazil, whether it's a current account in other markets or a checking account. That phrasing is everything. And I think the same will happen for stablecoins for it to garner trust. I think stablecoins 4 years ago meant so many things to so many different people. It went to a point where maybe folks wanted to avoid using that word because of the affiliation with crypto. And I think it's had a great resurgence because of a lot more definition over what does a stablecoin mean, how is it tied to a dollar, and what is a proven tried method. So I think that's really the last step from like a compliance standpoint is really earning the trust of the end user and helping them understand how this doesn't have ramifications beyond them running their business.
Yeah, it's super fascinating. I want to potentially get a little spicy with this question here, but like, so we're sitting here in New York, in the global north. Obviously, like Circle is the predominant coin in North America that is used, but in the global south, it's Tether. And then seemingly every day we hear about tokenized deposits from banks, and you know everyone's producing their own stablecoins. So like, y'all running your businesses in the economies that you guys operate, like where do we think the future's headed? Are we going to live in a USDC world? Are we going to live in a Tether world? Are we going to live in tokenized deposit land? Are we going to live in RWAs? Like where are we headed, and what do we think the future is going to look like with those coins?
Anybody want to be first on that one?
I can take a stab. So I'm originally from Mexico, and I live in Mexico. Mexico is very close to the U.S., and the U.S. rhetoric, as I mentioned before, like influences fairly significant, I think, many parts of the world, but it has a particular impact on Mexico because the U.S. is our biggest trade partner, et cetera, et cetera. And so you know, in my mind, the way that you kind of like, the narrative that I see playing out is, you know, USDC trying to be the regulated safe player, and then USDT maybe, the narrative at least in the US is that USDT maybe is not, you know, that regulated, et cetera, et cetera. You know, to the points that were made here, I think you ultimately need to understand what is the problem that you're solving for the customer. And particularly for our retail customers, like the customers want distribution, they want access, they want good pricing, and that's a place where like, at least we've seen Tether really outshine, you know, USDC. USDC is trying hard now, but that narrative doesn't, like, if you go to a small cueva in Argentina, a cueva is where you trade dollars for Argentine pesos. No one is thinking about whether USDT is safe or not, or whether it's compliant with US standards or not. What they care about is that I can turn it into my pesos whenever I want, and that there's a bunch of places where I can do that. And that just like the US dollar is accepted in whatever place in the world, and that's why it's so powerful, that is kind of like the power of Tether, right? Will people care about tokenized deposits? Absolutely, some people will care about that. Some companies will want to just work with banks. Will people, you know, will people want to use USDC because they see it as a more compliant option? 100%, there's some people that are going to do that. But at some point, these other things, in my mind, play a much more important role. And so if you're a USD issuer, a USD stablecoin issuer, I would be thinking really hard about distribution, like how easy it is to access, the liquidity in all these markets, if you want to do, you know, if you have aspirations for world domination.
Yeah, I mean, I agree with that fully. I think if you're asking about what does it look like in an end state, though, I don't think in an end state that it matters, right? And I think the best way, what I always compare it to is, let's say like Tether and USDT is Google and USDC is Yahoo, right? It doesn't matter. Like if you have a Yahoo account, maybe I'll judge you, but I can still send you an email, right? And so eventually you will have, I think hundreds of stable coins, right? I mean, you already have banks and everybody else that wants to get into the space. And what this looks like in the end is it doesn't matter what you're using, what I'm using. I can use whatever I want, right? In the same way that I can use JP Morgan, you can use Wells Fargo, and we can still transact with something like Zelle, for example, today. I think that stablecoins eventually will end up the same way. Right now, there's two dominant players, so it's not as big of a deal. But you will have more and more stablecoins coming out that will have the distribution, especially when banks get involved, right? The banks will have the distribution from day one, so they will have big market caps. They will have quite a bit of money flowing through the system. And eventually you're going to end up in a world where it doesn't matter what stablecoin I'm using, it doesn't matter what stablecoin you're using or what you want, everything will become interoperable, right? And you'll end up with, most likely some sort of open source system that everybody ties into, that a company like us and Bitso and everybody else on this panel would tie into, where no matter what stablecoin you send, everything is just dollars, right? And you've already seen this with some of the large crypto exchanges out of Asia, right? I think with Bybit and some of those, they just give you a USD balance, and that accounts for every single stable coin that you have. And once I have that USD balance, I can push it out in any stable coin, and I can take in any stable coin. So that's eventually where this is leading, right? Right now, we're still talking about stable coins. This stuff, it's literally just dollars, right? It's all one-to-one. Although, look, I do think we're going to $1.50. I'm very bullish, I will say. But for now, it's one-to-one. And, eventually we're going to stop talking about stablecoins. We're just going to start talking about, dollars. We're just going to start talking about digital dollars and how that's going to move around the world more effectively.
Yeah. Interesting. Looking for y'all on it.
Just to add maybe one other piece, I completely agree with, I'm standing on the shoulders of giants here, and I think my peers put it best and really diplomatically. And I actually, like the long tail after USDC and USDT, you're starting to see that there's a lot of participants that are passing on the underlying yield to distributors of interest, and I think that's very exciting. We're excited to, we support USDC, we support USDT. Recently we're very excited now, announced that we joined USDG. Big fans of M0 and what they're doing with it, high yield, and pass it on to the users as well. What I would love to see in the next phase of stablecoin issuers is there is this underlying issue that to get this one-to-one liquidity, that someone gets stuck with the bag. And what I mean by that is someone in this room inevitably wires the money to the US to mint USDC, or most stable coins, I should say, or some jurisdiction, whether it's Singapore, whether it's usually a single market with one or two underlying banks. And I don't think this is going to happen in the very near future, but I think it will inevitably happen, is there will be a point where there's a stable coin that is tied to assets across various banks across different jurisdictions, because one of the biggest constraints of stable coins today is the fact that we someone is inevitably paying for that and passing the buck on to the user, or making some other way to monetize off it. So the next phase naturally is how do you find the counterparts of the crossover banks, the US banks, the BNY Mellons, across these different markets that are willing to agree upon, and it's not a simple task, right? But the perspective here is that you agree to some FX schedule, you agree to essentially provide this underlying asset base so that it's easier to attain this liquidity, because otherwise we're relying on market making and other activities where it will never get truly one-to-one until we get to that point. So for a payments focus, that's where I'd love to see kind of direction in the next phase of stablecoins.
Well, I think this is a hard one, not necessarily specifically because of USDC and USDT, but there was an era of private money in the US 150 years ago, right? And banks would print their own money, and some bank's dollar was worth more than other bank's dollar. And your proximity to that bank mattered, that general, perception of creditworthiness of that bank mattered, and some dollars were worth 98 cents, and some dollars were worth $1.05, and the further away you got from the Bank of Connecticut, the less it was worth. And I'm old enough to remember when USDC depegged for a little while.
Old enough? Come on, man.
Yeah.
Come on.
How long ago was that? That was,
2023, no?
yeah.
2 years ago.
2 years ago. And they had a bunch of money in SVB, and like nobody knew whether or not they were going to get that money back. It depegged exactly the amount, of the reserves that were held in SVB. Like everybody was very smart about it, And I'm sure a few people made a few bucks on the trade of buying it at 97 cents or whatever, and then selling it again at $1. That shit really matters, And before that happened, there were a bunch of algorithmic stablecoins, some of which turned out to be, complete frauds, and some of which were just, incompetently constructed, right, and managed. And I think that it's worth remembering that at least for now, stablecoins are not money. They're a bearer instrument. They're a reference to money which is held somewhere else. Somebody wired money over to this place, and it's being held, and hopefully the promise is that you can get it back. And until there's like really solid regulation for really what that means, and knowing that like any shortfall in reserves are going to be topped up the next day or whatever, I think brand does matter, but also we're kind of like living in a somewhat precarious place where like, I think these are probably fine. I think USDC is very safe, but like, you run the perpetual risk at the moment because these are not really well-regulated instruments in a lot of places, that you could have another one kind of like just go below $1, which is the risk with the cash management account. That's why they have to be called cash management accounts, because they're money market funds and they can go below $1. They're not it's not really a checking account. There's no money behind it. And I think that this is just like an important thing for everyone to remember, especially as these things are marketed as dollars and everything. And I don't think that's like necessarily a bad thing, but if there's a bad event, again, it can set everything back quite a bit. Like trust really matters in financial services. And, right now, kind of anybody can mint a stable, which might not be the best thing long term.
Absolutely. I think so. We've got 10 minutes left, and then we'll get to 2 final questions here. So maybe just rapid fire responses on this one, and I might kick it to you first, Chris. But talk to us a little bit how you think about policy. How does policy shape your product roadmap? Not just from the U.S., right? Because even in the Genius Act, there's like debate where some stablecoins might be treated as securities if they're yield generating. Some might be just used for payments, and what does that mean for the ecosystem going forward? But like, how do you navigate policy landscapes not only changing in the U.S. but also in the economies that you guys operate in? So maybe I'll kick it to you, Chris, for Africa context.
In terms of like our product roadmap.
Yeah.
I mean, number one, innovation is always going to front run policy and regulation. Number two, I don't think you can predict policy and regulation. I mean, you can try, but at the end of the day, it's sort of out of your hands. So, the way that we see it internally is, build cool shit and then lobby for it if needed. I think the changes that we've seen in the U.S. obviously have done a lot for regulation around the world. But if you go back before November, there was no better place on earth to be doing a company in stablecoins than the African continent, where you had more regulators that have licensing available. You had more engagement with regulators. You had more friendly trends over the past 2.5 years than you did in any other single continent in the world, again, until just recently with everything going on in the US. So I think, in terms of product roadmap, obviously, look, you can't do things that are blatantly illegal, but you can't let the absence of regulation affect innovation, right? Innovation always has to front run the regulation.
Yeah, similarly to what you said, a regulator will never anticipate innovation, right? It's not part of their job description to regulate things that are irrelevant. And so I'm a very big believer that the progress of humanity and the progress of financial services depend on those people who are figuring out how to be innovative and how to basically like play maybe a little bit on the gray zone in the name of kind of like progress. And I think you contradicted yourself a tiny bit, because I do think that the industry has a significant amount of influence on regulation, and then you said later, you know, build cool shit and then lobby for it. And I do feel like we get the ability to do that as the builders and as the people who are pushing out that product. I think it also kind of like falls a little bit on us to be very proactive when it comes to regulation and then shape that. And you're absolutely right that ultimately it's a little bit out of our hands, but I think there's a lot of shaping that we can do. And at least in my experience, so when we started Bitso, our first set of products was nothing to do with stablecoins because they didn't really exist, but it was more crypto, or actually Bitcoin buying and selling. And we had to build that outside of any regulatory framework. So we tried to kind of like follow the spirit of the law, et cetera, et cetera. But once there was regulation in place, because now our operation is fully regulated, it actually unlocked a tremendous amount of growth, because it brings that confidence and that trust that you're talking about. It actually then gives a lot of clarity to a lot of the players. And so I feel like these are like tensions that you need to figure out, how do you basically leverage the force of each? Like, when do you need to be a rebel or a trendsetter, or like, you know, just pushing the boundaries? And when do you actually use what has been created and use that to your advantage to also continue to grow?
Yeah, I think you guys make a lot of good points. I think the trends that have happened in like stablecoins and crypto in general have been in front of regulation. I think in fintech history, it's kind of been on the opposite side of the fence sometimes. Actually, oftentimes. If any of you had seen a neobank or seen a lot of them come about, many of you are already familiar with the Durbin Amendment and what that brought about. The quick context on that was, it's no coincidence that several banks like Chase issued what eventually become very popular cards like the Sapphire card. Any bank that had over $10 billion in assets essentially was capped on how much money they can make on a card transaction for transactions below $25. And as a result of this, you had this long tail of regional banks, or about 10,000 financial institutions in the US, many of which realized that they could become the underlying bank sponsor for what would become a new influx of fintechs over the last decade, and really pioneered this concept of sponsored banks working with financial services. On the flip side, the big banks realized that they could no longer monetize on these like opportunities with debit cards, and so many of them started becoming more inventive and creating all these amazing perks that me and my millennial zeitgeist bought into, the Chase Sapphire and all the other cards. I'm sure many of you have as well. Realized that they would have to capitalize on the upside of credit. Same goes for open banking, right? With data aggregators, a lot of it follows like the work that happened in Europe with PSD2. We talk a lot about what happens in the US, because the US is like a weird anomaly from the rest of the world. Everywhere else in the world, 5 to 7 banks have 90% market share of deposit accounts. In the US, the top 3 are not, by law, allowed to have more than 10% apiece, at least through M&A, which is why when Bank of America bought Merrill Lynch, that was like 10.1%, and they let it slide because it was 2008, and the economy was in crisis. But all to say that historically, there have been a wave of new companies that have come about with regulation, with PSD2 begetting data aggregators and open banking all over the world, with the same for neobanks in the US, and then historically the rest of the world. And I think regulation's been a bit laggard within stablecoins and crypto, but I think it's now catching up. And it's, as you guys had said, really instilling trust within the end user.
Yeah, I just think you have to think deeply about like what the regulators care about and what their interests are, and you know, in the absence of regulation, you know, just try to make sure that you're not doing anything which is going to bring it down faster, and that you know you're respectful of the interests of society, and be fine. I think you're exactly right. You know, you got to just get ahead of it.
Absolutely.
Yeah. 100%. Well, I know we got about a minute and a half left, so rapid fire. I'll start with you, Mike, and we'll go up this way. But the stablecoin community is quite it's small, but it's growing. I think it's pretty collegial. Everyone likes to help out and be a friend where they can. There's a lot of people out here on the stage that are building, that are thinking about what's next on the product roadmap. Like in emerging markets or in the global north, where do you see, I guess for the audience really out there, like where are some of the biggest gaps in the market that if someone was building today, they would say, here's some products that we definitely need out there in the market?
Man, I don't know. I just think it's like, Amazon has it's day one. Like we're so early. Like I saw this thing on Twitter the other day, which is like a graph of stablecoin volume, and it, it's like zoomed in and it goes like this, and then it kind of goes like this. But like in the grand scheme of things, with the amount of money that moves around the world right now, like, we're nowhere. The opportunity is literally unlimited, and everything is a gap. And if you went to like a conference in, I don't know, like 2000, there would have been, 100 companies up there, and you'd be like, oh my God, like what, there's nowhere to build. But of those 100 companies that were there at the time, I don't know, half a dozen of them are like still a thing, Like there's unlimited opportunity in this space at the moment, like truly unlimited, and it'd be great.
I gotta echo Mike. Honestly, it's so early in the curve, it's hard to say. Like, I don't know, it's easy for me to think in numbers, and I heard the stat the other day, and I saw a Wise backpack in the front, and I was like, this came to mind. Again, using Brazil as an example, where outside of the traditional banks, you think about who's the biggest player for FX, it's Wise that does 60 basis points of FX volume in Brazil. When you think about global money movement and how much Stripe has in that effect, it's less than 2%. All of us are still very early and new. I think Stripe has lots of opportunity, Wise has lots of opportunity, everyone on stage here. We're still in the early innings, and it's hard to say. There's a lot of opportunities for credit on-chain, a lot of still coming off-chain. There's a lot of ask and demand for that in the B2B world for access to liquidity. More often than not, that's more important than payments. Payments is, I think as many of us know, it's a race to the bottom. Like on-off ramps will eventually, they won't get to zero, but they'll get close to it. And so I think there's opportunities to build a lot of what we've seen off-chain, on-chain happen, including working capital for that matter. Pretty cool.
Yeah, so I think whenever you see like one of these big innovations, you always see what you're seeing in the stablecoin space today, which is people take something that already existed in some form and then they bring it into this other form. So when the internet came up, a bunch of people like started digitizing, newspapers, publications, etc. But I think the real magic happens when you kind of like look at the technology from the ground up and say like, oh, I can actually build something new that couldn't exist before. And that's how you start getting like all these like social networks. Like we couldn't really build a social network really before, right? Now the internet kind of like enabled that. And then with mobile telephony, suddenly you get the ability to do Uber, right? And these, these kind of like really interesting shared economies. And so if I would be someone, if I wasn't building Bitso and I was interested in stablecoins, and I'd be sitting in this audience and I'd be thinking like, where are the opportunities? I'd be very intrigued to think about like, what is the new category of thing that is going to be enabled by money being really global and by everything that we discussed, like all the properties about like this, the protocol, is this a TCP/IP of money or whatever it is, but what new can you really build? Bitso is trying to do something very similar, like I think all of us are, like basically move the existing into something more efficient, et cetera, but I believe that we're going to see over the next few years these new categories of things that couldn't work on correspondent banking and closed systems, and now they're going to be enabled, and I think there's going to be a big opportunity there.
Awesome.
Yeah, I'm very biased towards payments, but look, one thing that I think is very much available and would be very cool for somebody to figure out is everybody loves to complain about interchange, but at the end of the day, my Visa card pays me 2% cash back. I don't have to pay it for 30 days, and I get consumer protection. So I'm going to continue to use my Visa card until there is a really good solution that gives me generally those things, and makes it better for me as the consumer. And so I think, look, will a lot of that stuff move to stablecoins? It certainly will. And I think interchange and stuff like that will, there will certainly be a day where that stuff starts coming down. But there's going to need to be a very innovative solution built. And there's still a lot to figure out with the consumer experience for stuff like that.
Absolutely. Well, thank you guys for your time, and thank you for the audience for sticking around and listening to us. And we'll be around. Thank you very much.
Thank you.